So there's not as many businesses in the marketplace now that have inventory, but from those that do, they have a unique challenge of managing that idea, because I've got to invest in goods that I've got to have available. I need to make sure that they keep flowing. I need to be profitable on them, and I need to know really what the appropriate margin level is, and really I need a way to determine which items that I carry I make the most return off of. And it's not always as simple as a dollars calculation or even a margin percentage calculation. So it's not, you can look at revenue, you can look at gross margin dollars, you can look at gross margin percentage, you can look at a common term called inventory turns. But really I like this idea of gross margin ROI. And gross margin ROI, there's a couple of different methodologies of how people calculate it. And really the way that I like to apply it, which may not be the academic way, but I use a version of it called turn and earn that I think actually communicates best to me where I want to put my money to work in inventory, because it really combines profitability with speed. And so what I'm trying to do is get that profitability through my business as fast as possible, because I need the greatest amount of velocity of gross margin with the least amount of capital investment to fund it. Whether that capital comes from debt or equity is irrelevant, but there's a cost to that capital from that process. So I'm going to show you an example that was shared with me with a professor from Wharton Business School, and David Wessels. And David really helped me understand this idea in a great way, so I'm appreciative to him of me understanding this in a much better way. And so it's looking at an auto parts business to where you've got a ranking of here's all the parts that the company sells, and you can see the average revenue rank of the percentage of where all the money comes from. And so first level analysis, people have a tendency to look at revenue and say, well, gee, those top 5 or 6 products are really kind of our big sellers. Let's keep selling because we want to grow in that process. Well, let's take it one step further and look at it from a standpoint of not only their revenue ranking, but let's look at their gross margin dollar ranking. And so when I start to rank those, I can start to see that spray lubricants and body fillers and putty, items 5 and 6, and even sandpaper, wet or dry, was my 10th. Those items start to shift downward a little bit in terms of gross margin dollars, and a few of the items in the bottom section start to shift upward a little bit in that process. So that's still better than just ranking by revenue, but still not really where I need to be. The next level is really the best way to look at it, is where you're really ranking it by my version of gross margin ROI, which is taking the gross margin percentage times the inventory turns on average for that item. And so, like I said, the turn is kind of telling you how fast that item gets through your business in that process. And so to me, this is the more intuitive way of looking at this calculation, from this standpoint. And you can see that as I now rank the products by gross margin ROI ranking, you start to see that, from a revenue ranking standpoint, I've got 5 products that were in my top 10 in terms of revenue ranking that are now in my bottom 10 in terms of speed and margin production. And so that's really telling from that standpoint, because it really starts to put pressure on my ability to grow profitably without having to continue to put more and more cash in the business. And I've recapped these at the bottom, but really on this next summary page is really where you can kind of tell the story. Now, irrespective of the fact that I've got to sell whatever products my customers expect me to have, but realistically, if I'm really directing my salespeople to push the products that we make the most money off of that are needed in the marketplace, they need to know that. And so certainly we're going to do what the customer needs, but I need to make sure that I've got really tighter inventory controls on those items that are slower and lower margin. So if I look at this particular example, if I decided to take the top half of my business and double it in size, it would require roughly a $900,000 investment in inventory that I would make $1,343,000 in gross margin off of in a 1-year time. So in essence, I would get my money back in 8 months from that grouping. If I looked at doubling the bottom half of the inventory, I would have to spend another $1,072,000 in inventory to double it to get back $1,025,000. So I would have to wait a whole year to get my gross margin back based on that investment. Now, in those particular structures, that's what we call growing broke. And so, when I can get my money back in 8 months, that's a much more enticing offer, because think of it like this, in a sense, a $900,000 investment. If the bank helped me fund that, I would be able to give them their money back in 8 months, and then I'd be able to pocket 4 months of that gross margin to then improve my growth of the business and improve my cash flow in that process. And so in this particular case, a good rule of thumb is when you use the turn and earn calculation, like I said, is taking turns time gross margin percentage. To me, you got to look at the funding level that each business is required, but usually anytime that you get to that 100% turn and earn calculation and above, that's usually when it's telling you that there's enough velocity in that process. Once that I get to 100% turn and earn and below, I've got to look at that item and say, where am I going to get the cash to fund this? Because probably a debt source is not going to be patient enough to wait to get repaid, and that inventory is not going to turn over fast enough. Now, you got a whole bunch of other issues in terms of inventory that ultimately doesn't sell. I make bad buying choices, the market shifts, and all that. But just from an active inventory that you know that you're going to buy and sell and trade, this is the most valuable technique that we've seen in terms of doing product analysis and also channel analysis as well. Not only is it by product, but I want to look at it by selling source. What I sell via internet, what I sell via walk-up traffic or direct store sales, in those kinds of processes. And typically one of the best techniques of this is actually look at this on a quartile grid. And in terms of looking at that fourth quartile in terms of the slowest moving, lowest margin items, and let's try to find a way that, can I make it move faster? Can I improve margin by different decisions in those things, and certainly start to move it up and get it to a better operating scale?